Sadiq Adatia is Chief Investment Officer at BMO Global Asset Management. He joins us with his take on the Canadian economy on a busy day with the budget as well. Sadiq, it's great to see you.
You too. Thank you.
How would you characterize what you're seeing in these inflation numbers right now?
I think it's kind of as I would expect. Nothing that's going to really cause alarm bells by any means, but also highlighting that just like the U.S., going down this last mile on inflation is going to be a lot tougher than people are expecting. But again, at least unlike the U.S., this was not necessarily a surprise and in line with kind of what people were thinking that we would get over the short term. And as you alluded, housing, rental costs, those are things that are still going to be big drivers of inflation. And now we also have the energy pickup as well.
Yeah, and like when you look at the different components of price pressures, which ones matter most to you?
Yeah, I think when I look, exclude those two areas, yeah. I think inflation is coming down in the right way. And I think if you did include that, you'd be under that 2% threshold. Now, you can't always just exclude everything. But I think, when I look at energy, the supply-demand situation is pretty good. But you got geopolitical risks that probably will keep it at a higher level. On the other hand, when I think it through, on the housing side, that comes down to a kind of a circular pattern, right? If they cut rates, you'll reduce that problem, reduce inflation at the same time. If you don't, you keep that inflation number high as well, too. So to me, I think the Bank of Canada's got to start thinking about, we should start to cut rates, start to look at the fact that, that will bring down housing shelter, that will make it a little bit more affordable on that side as well, and let energy just do its thing because they can't control the energy prices. It's out of their control. So the only thing they can do is help consumers a little bit, bring down that inflation a slight bit, and it won't drive up inflation just because you're cutting rates. Will actually reduce inflation, in my opinion, in the short term because of the housing costs.
And then let's just talk more broadly about Canada's economy and your sense of what's going on right now, because certainly what you pay at the gas pump, what you pay for your rent or for, your mortgage, these are all considerations that lead to, not having necessarily enough disposable income to go shopping every weekend or what have you. But when you look at the health of the economy, what do you see right now?
I see a deteriorating economy. Just as you alluded, the consumer is weakening. You've got housing debt that is quite high. You've got credit card balances that are high and starting to be unpaid and becoming problems on that front. Same thing on the auto car loans as well. So the broader consumer is weakening, tightening up their belts. They're changing their pattern of spending as well. So that is a good sign to me that the economy is going down a path that the Bank of Canada does not want it to see in a hard way. But I don't think it's going in that hard way. I think it's going in a softer way, and that is fine for the economy and for the interest rates and inflation, because that just means that we should probably end up with a soft landing or, in worst case, a mild recession. I still think you can't throw out the mild recession out of there yet, because I do think that that's where things are heading.
I referenced the fact that the Canadian dollar has been steadily weakening against the U.S. currency, and that part of that dynamic seems to be that people are thinking interest rate cuts have sort of as a conversation piece have been pushed out in the United States, whereas you would not be surprised at some point soon to see the Bank of Canada signal they're ready to cut. That's
right. My bet is that we'll probably do it in June or July, a rate cut in Canada. I hope they go June, but I can see them delaying it because they think the Fed is delaying it as well. With the Federal Reserve, I would not even be surprised if we did not get a rate cut this year.
Really?
But I think they want to put a signal out at least that they're cutting. So I think you will get the one. But I think 1 to 2 is where we expect the Fed to be at, and maybe 2 to 3 in Canada.
I do want to talk about how all of this impacts the markets. You've got plenty of strategy ideas, which we're going to get to coming up. But the other big thing today is we've got a federal budget where, we talk about the outlook for the economy and where, spending needs might be greatest. From a Bay Street perspective, what are you curious to see with the budget?
Yeah, like most things, you want to see money spent on infrastructure and jobs. You're definitely going to hear something about on the housing front as well. So all those things are important. You need to have the consumer spending, and you need the consumer to have more jobs out there still. We've had a great employment picture, but you are seeing softening there as well. So that's the kind of things I want to see. I don't think you see anything that's going to drive the market significantly higher overnight or cause the market to lose confidence overnight either. I think these are just marginal things that have to occur. as we rebalance back from the COVID situation that we've been in over the last few years.
Does government spending impact the inflation story in your perspective?
It will marginally, but I think it'll be more temporary, personally, because I think as you look at the broader inflation story over the next few years, inflation on the rest of the stuff should be coming down. So yes, this will bring up a little bit of inflation, but I don't think it's going to be detrimental or cause any problems on the interest rate front.
Okay.